What is up, YouTube? My name is Daniel and you are tuning into Life with Dan. I've got another stock market video for you guys today. So welcome back to all of you that have been here before and welcome to the newcomers. Rather than going into individual stocks or anything like that today, what I'd like to do with this video is give you guys a handful of tips, some information with regards to being a first-time stock market investor and making that decision to buy your first stock. Basically, what I'm going to be doing is giving you guys a lot of the information, a couple of the pointers that I wish I had been told prior to buying my first stock. If I knew these things that I'm going to be laying out in this video prior to becoming an investor, I definitely would have saved myself a lot of headache and definitely would have saved myself a lot of money. So with that said, I'm hoping that this video provides a lot of value for you guys, especially those of you that haven't yet invested but have been considering doing so. So if you do get anything out of it, I just ask that in return you guys please do me the favors of hitting the like and subscribe buttons so that I can continue moving on and progress with my channel. So with all of that said, we'll get into it right after the intro. So to get right into the first tip of the day, guys, something that's very important to know, especially as a first-time investor, is that stocks do not always go up. I make a point to say this now with the market that we're currently in, with the things that we've been seeing in the past couple of weeks, months, because depending on what you've been paying attention to some it might seem like it's been a pretty just straight green market the past couple of months. If you look at these headlines here, I mean, when you look at the S&P 500, the Dow, the NASDAQ, I mean, they've been breaking records over these last couple of months. And individual, no-brainer companies, if we can call them those, the ones that we all tend to look at right away when we become investors, right? In the tech sector, things like Apple, Facebook, Tesla, Google have been having great runs. If we look at the retail sector, no-brainers like Target, Walmart, right? They have been having good runs. So it just seems like all around things are moving up. And I know that this might be easy to take and just assume that that's what the market's always like. It's very easy to fall into that, or at least to really want that to be true, guys, especially when it's something like this, when the market is just going up. But I think it's important to point that out now and to tell yourself right out the gate before you even buy that that is not the case ever. Just because they're having a big run right now towards the end of the summer in 2020 doesn't necessarily mean that 2021 at the same time of the year, the same thing will be happening. I mean, it could be down for the tech sector come summer next year for all we know. I'm not saying that that's what's going to happen, but I'm just trying to make the point that things are not always the same. The market is by nature a volatile place. So you should never just assume that it's always going to move up, because if that were the case, everyone would have already been and put their money in the stock market and we would all be rich, right? So obviously that's not the case. It's not how it works. And it's something that could mess a lot of people up. I mean, ask anybody that does this professionally. Look at any of these, analysts, news articles, all these professionals that are getting asked their opinion. It is a weird time for the stock market, guys. Things are overvalued. I'm not going to point out any individual names or whether or not they should or shouldn't be overvalued, but it's a weird time. So take care of your money. Don't assume that things are just prosperous, green forever. Stocks don't always go up. Just because something's happening now doesn't mean it's going to be happening forever. Now to move on to stock market investor tip number 2, guys, it goes hand in hand with knowing that stocks don't always go up and that the market is volatile, that you should have an entry and exit plan for any stock that you plan on investing into. If you're looking at investing into a stock, let's call it XYZ company, you should know before you get in what return you personally want to get out of XYZ company. So if you're going to invest, do you want to make 25%, 50% on your money, 75%? What goal do you have with regards to the return you plan on getting? It's important to ask yourself this because let's say you get into the stock and you get to that certain return, you want to know what it is that you're going to do, and you want to stick to your plan. So the entry side of the strategy is knowing, like I said, what return do you want to get out of the stock. Another part that's included in the entry part of the strategy is at what point do you get into the stock. If you're looking at XYZ at $60 a share, is that the price you get in at? Or are you anticipating it goes down in the next few weeks or in the next month and you want to get in the high 50s or maybe mid 50s? Is the plan, something else? Are we waiting for earnings to come out because you anticipate this to happen and that's when you'll get in? So, just because you're going to invest in XYZ company doesn't mean that at any moment in time You buy XYZ company. You plan the buys. You strategize when is a good time to buy the company. Overall the company might be great, but its stock right now might be too expensive. So, all these things are important to consider, and it's all part of the entry and exit plan. So on the exit side of the strategy, what you want to ask yourself is, okay, I've already decided what return I want. Let's call it 75%. I anticipate I'll make 75%, and let's say, we decided on some amount of time that it would take to get there. Well, when that time comes, what are you going to do? What's the plan? So let's say, you've held XYZ for a certain amount of time, and all of a sudden, now you're at that return. You are up 75% on XYZ. You've got to make a decision. So prior to getting here, you've already kind of told yourself what the plan is. When I hit 75% return on XYZ company, I think I will sell it all. That's one way to go about it. I think I will take some off the table. Maybe I'll take off half of XYZ, take the profits there, and leave the rest, the other half, still invested. Okay, that's one way to go about it. Or maybe, you trim only 10%, what have you. But you need to know what it is that you're going to do. If you do these things, you build yourself a plan for a stock that you're going to get invested into before you buy in, and you tell yourself, I want X return, and I'm going to do this when that happens. You'll find yourself in a much better position when your returns come. You won't worry. You won't be stressed about, oh my goodness, am I going to lose all this gain if I don't decide on doing something? Because you will have already decided. You'll have a plan set in place, and you'll know what to do when things come. So now that we've covered the idea of having both an entry and exit strategy with regards to any stock that you hold, my third bit of investor advice is that with regards to any stock that you have, regardless whether you have a long-term view on it or a short-term view on it, you should always have a buy and homework mentality with any stock that you hold. Buy and homework is something that I got from Jim Cramer. He's one of the bigger news heads on CNBC. He'll eventually come up in your view, whether it's on YouTube or an article or through news or something like that if you are a new investor. But basically the idea behind buy and homework is that whenever you get into a stock, you are constantly doing the homework on it. You're always up on top of any news that comes out on the company. Basically, with any stock that you're holding in your portfolio, you have to always at any time know everything that's going on with it. You've got to be that over-obsessed boyfriend or girlfriend that just knows everything about the companies that you invest in. I'll put it to you this way. If we were looking at each other's portfolios and I picked a random stock out of your portfolio and asked you to explain it to me and tell me all about how it works and what they do and whatnot, would you be able to do so? And that's actually a pretty good practice to have, guys, to be able to see and check yourself, kind of see if you can explain what the companies do. If you look at what you hold and you absolutely know nothing about what they do, that's not a good sign, guys. It's usually a sign that you're just gambling on the stock. You're seeing people interested in it, and you're banking that it's going to move up, whether that be short term or midterm. Or sometimes people don't even know how long they're really thinking about holding that when they have that mindset. So when you think back to the previous point about having an entry and exit strategy, right? The whole idea of buy and homework is the constant updating of your entry and exit plan, if you can think of it that way. So even though at one point you might say to yourself, okay, I want 70% return from XYZ company, and I anticipate a 2 to 3 year outlook on that for it to happen, right? But then something happens that sends the stock up or down big. One earnings report might be completely left field, something that no one expected, and it sends the stock tumbling. One earnings report might be just the greatest beat ever that the company's ever posted, and you see the stocks all of a sudden up big. So, you just want to be on top of everything. You want to do the homework, essentially. You want to be the good student, and you want to not miss out. And in this situation, it's only hurting you if you don't do the homework. If you're not on top of things, it's your money that could get lost. It's you that could end up in a loss if you're not on top of what's going on with the companies that you stay invested in. If you're going to buy a stock, what we've done so far, never assume it's just going to be an easy ride. Always have an entry and exit strategy, and always be doing the homework in case you need to update that strategy so that you don't get caught slipping. So as we move on, we see the fourth investor tip here is going into the correlation between the price of a stock and the actual valuation of the company that stock belongs to. This is something that people get confused right out the gate, and it very much affects the purchases that they make and the way they go about approaching stocks. Essentially, what you see happening when people get into the stock market who have not really done a lot of homework, who don't come from an economic or financial background, is people will come into the market looking for cheap stocks. So you look for I guess, essentially bargains. People come into the market kind of like shoppers. They treat it as if they were shopping. And when we go shop, those of us that are savvy and trying to save our money, we look for deals. We look for things that are cheap. We try to avoid the things that are super expensive. What ends up happening a lot of times is an investor sees a cheap stock and thinks, oh, wow, this is a new weird company. Like, it looks like it does something cool, sounds cool, and it's only $4 right now, or even a penny stock, even lower. Like, they might say, oh, it's only like $1 and something right now. And I just need to tell you guys right out the gate that that is not how you want to approach the stock market, guys. You should not look at stocks as some product on a shelf, at Walmart. This is not that type of thing. And price actually has nothing to do, independent of itself. The price of a stock has nothing to do with the valuation of a company. What that basically means is that an expensive stock is not necessarily saying it's an expensive company to buy into, basically. A cheap stock does not necessarily point to a bargain. So just because a stock is at $4 doesn't mean that it's more likely to jump up to $20 than a $100 stock is to jump up to, $200 or $300. Independent of itself, a price is just a price. But what actually goes into determining whether or not a company is expensive is its price to earnings ratio, is its market cap, and what price you get it at. So what are PE ratios and market capitalizations for those of you that don't know? Because these are important factors that you need to take into consideration in order to properly value a company, rather than looking at the price of a stock and thinking, oh, this is what this company is worth. So as you guys can see here on Investopedia, price to earnings ratio is actually a ratio that's used for valuing a company that measures its current share price relative to its per share earnings, or EPS. So it's basically a ratio that investors and analysts use to determine the relative value of a company's shares in an apples to apples comparison. Basically what that means is, one simple way to determine whether you should get into one stock over another might be that you just compare the PE ratios, right? So essentially a higher PE ratio means a more overvalued company. The higher the PE ratio, the more overvalued a company is. And market capitalization, or market cap for short, as you guys can see here, is referring to the total dollar market value of a company's outstanding shares of stock. It's calculated by multiplying the total number of a company's outstanding shares, or otherwise known as shares that are currently available for one to buy, by the current market price of one share. So it gives us a little example here. A company with 10 million shares selling for $100 each would have a market cap of $1 billion. Like I said, guys, PE ratios, market cap, things like earnings, these are the real factors you want to take into consideration when deciding whether or not a company or stock is expensive. And especially now that fractional shares is a thing, guys, when you can buy partial bits and pieces of a share rather than having to buy the whole thing, this should even more so reinforce the fact that you don't look at the price of a company when you're considering what to invest in. Because too often, guys, we'll miss out on great companies because, we'll be scared of the price per share that we see on the company. A $4 stock moving up to $8 would be just as significant a move as a $100 stock moving up to $200. It's still a 2x, guys. It doesn't matter the small number relative to a big one. So hopefully that sinks in and you guys can take that with you as you go about buying stocks, and hopefully that'll motivate you guys to get invested into companies that are worth getting into. And now to move on to the final point that I wanted to cover with you guys today. Essentially, if you have yet to get started in the stock market, you have to make a decision before you come in. What type of investor were you planning on being? Are you going to be a short-term investor, or are you going to be a long-term investor? Do you plan on buying and holding for the long term, or were you planning on doing more of a day trade, more of a flip kind of gig where you buy and hold for the short term? It's definitely important that you make this decision and that you tell yourself and you put yourself in the mindset of what kind of investor you want to be before you get started. And I'd say it's for two reasons. One, it's going to affect how you're taxed. And two, it's going to affect how you go about the market. It'll affect how you watch it, what news you look out for, and essentially what companies you go after. Speaking in tax terms, long term would be considered anything that you hold longer than a year. So long-term investors, with regards to stocks, hold stocks for more than a year, and short-term investors hold them for less than 12 months. I personally am more of a long-term investor. Most of the stocks that I buy, I plan on holding for more than a year, simply because I approach them with a long-term mindset. Some of the stocks that I hold are ones that, have a certain turnaround that they still have to make. For example, Boeing, I'm waiting on the recertification of the 737 and for travel to ramp up again. So, when you take a long-term position, you are taking things into consideration for the future. You're planning on what a company is going to be doing, over the next couple of years. You care more about its development, its growth, what's going on in its financials. I feel like long-term investing is more of an involved approach. Whereas short-term, you might be thinking, I am invested in this company because it is one that is going to be very hype for the next however long. It could be months, weeks, days, whatever it is that you're doing as a trader. But I feel like most of the time with trading, the hype is more around interest in stocks rather than interest in the actual companies that the stocks belong to. So like I said, not only is it important to consider what type of investor you're going to be because of the fact that it'll influence how you go about navigating the market, but like I said, it also affects how you're taxed. And this is one thing that I think people that just get started with the stock market often miss. This is a side income. This is a source of revenue, and it is something that you would have to report on your taxes. And depending on whether you are a short or long-term investor, you actually get taxed differently. I pulled up an article on Investopedia here that basically goes into the differences tax-wise anyway when it comes to selling your long-term or short-term gains, so that we can get a better understanding of the benefits or downsides to being one or the other. As you guys see, it says here that when you sell a capital asset, in this case we're talking about stocks, for more than you paid for, the result is a capital gain. The tax you'll pay on a capital gain depends on how long you held the asset before selling it. Capital gains are classified as either long-term or short-term and are taxed accordingly. So this is going to be very valuable information to a lot of you because it's going to very much impact how long you hold a stock, especially if you're someone that's not investing very large amounts. You can find yourself coughing up a big chunk of your tiny gains and it not being even worth it to be a short-term investor. And the reason being, guys, as you can see in another part of this article here, when you actually sell one of your stocks for a short-term gain, you actually end up getting taxed differently than as if you had held it for more than a year and then ended up selling it. As you can see from the article here, when you sell a stock for a short-term gain, you actually end up getting it taxed as your regular income would. So short-term gains are actually subject to regular federal income tax. So what that means for the short-term investor is basically, assuming you work a regular job and have some sort of regular income already, you can find your short-term gains ending up in a higher tax bracket because your income that you already make every year ends up putting you into a higher bracket. Here are the tax rates for long-term capital gains. So depending on your filing status, this is what you would get taxed per your capital gains. As you guys can see here, for long-term investors, there is an option for a zero tax rate up to certain amounts depending on your filing status. Not to mention, guys, what we just talked about, long-term gains are their own separate tax filing. So these numbers that you see here on the chart with regards to the limits per tax rate are for capital gains alone. They do not have to get mixed in with your income like short-term capital gains do, which is a nice upside. When we look over at the short-term capital gains, the minimum you're going to get charged here is a 10%. So right out the bat, no matter what, if you are trading for the short term, you could see yourself coughing up 10% of whatever it is that you gain. Unless, like everyone else here in the United States, you have a job, in which case you could possibly see yourself falling in an even higher tax bracket. So yeah, it definitely gives you some stuff to think about, guys. If you ask me, if you're someone that makes more than $40,200 a year already at your job, automatically it isn't worth it, in my opinion, to be a short-term investor, because your short-term gains are automatically going to fall into a 22, if you make more, 24% tax rate. To give you a tiny example of what this could look like, for your average everyday person, let's say you work at an Amazon distribution center in California and you make, I don't know, maybe 42K a year, right? Just to give you an example. I'm not exactly sure if that's how much people at Amazon make. I'm just making this up. So you make $42K a year, so you're going to fall into those higher tax brackets. And let's say you have $1,000 invested in the stock market, right? You have $1,000 invested into one particular stock. Let's use our XYZ example again. And let's say in a matter of 2 months, you luck out and the stock has a huge move. You're up 50% already, and you haven't even had the stock for 90 days. So now your market value would be at $1,500, and you think to yourself, man, that sounds pretty good to me. 2 months, I already made $500. I'm going to go ahead and take that whole thing out. If you pull out the full $1,500, you're going to get taxed on your gain that you made on that stock. So you're going to get taxed on the $500. So what that means is that right out the gate for our Amazon employee, he or she is going to have to cough up $110 to Uncle Sam. Doesn't sound nice to me, guys, and that's one of the reasons why I think I would just rather stick with long-term investing. Now, to some of us, depending on your situation, the differences in tax rates might not matter to you a whole lot, and you might not have a problem with coughing up 10%, 12% of your capital gains, depending on how much you're making. Maybe the capital gains that you made are worth coughing up that much of an interest. But for some of us, we prefer to pay nothing, and that's why I kind of try to lean more towards holding companies for at least a year. The only way to really get out of this taxing for short-term gains is to fall under a trader tax status, which is actually a thing. There's actually a status that you can fall under that considers you a trader, where it's like your actual daytime job to trade. But guys, it is not easy to fall under that. I hear that you have to do a lot. I mean, you have to do like some 5 minimum trades a day or something crazy. Maybe I'll do a video on that down the road, but to put it simply, it's not an easy thing to achieve. For your average person that's doing, just a couple of trades every month, you're not going to fall under trader status, and it's going to be something that you're going to have to just not consider. So with all of that said, my fellow YouTube friends, that just about wraps it up for this video. We've gone over 5 different investor tips that I think are pretty essential for you to know before you get started in the stock market. I'm telling you, if I knew all of these things before I got started, I would have felt a lot less scrambled, a lot less confused, and I would have had more of a hold on my investing from the get-go. Definitely take the time to take these things into consideration, think them through, and see how they can fit into your own soon-to-be stock market portfolio, or the one that you already have if you haven't been implementing any of these strategies. I hope to continue my stock market series that we've got going on here. What I'm thinking about doing for the next episode of Stocks with Dan is going into the biggest L that I've ever taken in the stock market, just talking about my biggest loss and how I dealt with it / how I'm dealing with it, and kind of what I've learned from it. And aside from that, I'd like to put out another stock update video for you guys on some of the stocks that I'm interested in, because it seems like I thought of this video at the right time. It just takes me forever to edit, so I'm a little late on it now, but this turnaround in stocks seems to already be starting. I talked about how it can't go up forever, and it just so happens that we are now having double down days for big tech companies, and so who knows how it's going to keep going as the week progresses. It's September 3rd right now, so we'll see how it goes. But anyways, let me not take up any more of your time, guys. I appreciate each and every single one of you for tuning into my videos, the newcomers, the people that are back again. Thanks for supporting the channel, and we'll see you next time on Life with Dan.